Okay, so you got £10,000 and you're wondering where to invest that money to ensure that that money is working for you. Because let's be honest, if you don't get your money working for you, then you'll work for money for the rest of your life. And what that means in practice is ensuring that the value of your money goes up over time. And that's beyond that of what you could expect to receive just from putting that money into a standard savings account. Because let's say that you had that £10,000 in a savings account, earning a 2% rate of interest per year. Well, after 30 years, the future value of that money would be £18,212. Whereas if you had that money in a high-yielding investment, say a conservative 6% per annum instead, then that £10,000 30 years from now would be worth £60,225. So in today's video, we're going to discuss 5 different possibilities on how you can go on to expect to achieve those kinds of rates of return in order to grow your money over time. But we're also going to discuss how you can actually grow your money to in excess of over £250,000 just by following some very simple strategies, but we're going to discuss that a little bit later on in the video.
Yeah, boy.
And in return, all I ask is that you drop a like on this video. It really helps out the channel, along with drop a comment down in the comment section below on what your favorite investment is too. So let's start off with option number 1, which is probably one of the most unexciting methods, but it's certainly one that's worth your while, which is to pay off any high interest rate debt. Now you might be thinking, well, how is paying off debt going to make me money? Well, in short, it won't make you money from doing that single thing, but it will be beneficial. Let me explain. Say you've got outstanding payments on a car loan or a credit card. Perhaps you're paying 10 to 25% in interest. Here's my reasoning behind wanting to pay off an interest rate that's so high. Firstly, there are 2 types of debt. Firstly, you've got good debt, which helps put money back in your pocket in the future. And then secondly, you've got bad debt, which takes money away from you in the future. And if that bad debt is costing you at an interest rate of 10 to 25% per year, well, it's costing you the ability to invest that money into income producing assets that increase in value over time. And let's say that investable asset can increase anything between 6 to 15% per year. But when you take on the risk of investing into that asset, the returns aren't exactly consistent. If you take a look at this chart of the S&P 500, and I'll explain a little bit later on in the video what the S&P 500 is in a little bit more detail. But what you can clearly see is that some years we've seen positive returns and on other years it's given negative returns. So the value of your £10,000 invested may go down in value before it goes up. Whereas putting that £10,000 towards paying off your high interest rate debt, for example, if you've got credit card debt, paying 20% interest, it's almost like guaranteeing yourself that rate of return. So with that in mind, it should certainly be a goal to get rid of all of your high interest rate bad debt in order to actually have that money to invest in income producing assets that go up in value over time. So let's start off with the first asset that you could actually invest £10,000 into, and that's a retirement fund. Now, whilst an employee pension is always a great starting point, in today's video what I wanted to discuss is how you can actually have a self-managed investment portfolio that you could pay a £10,000 lump sum into. Now, to begin with, for any investments that you're looking to make for retirement, I would always look to use, where possible, a stocks and shares ISA account. It's a tax-free investment account where you can invest up to £20,000 per tax year, where you pay absolutely £0 and 0 pence in tax on any of the capital gains that you've made.
Nice.
So that's always a starting point. Get a stocks and shares ISA account if you haven't already got one. And now let's talk more specifics about the types of investments that you can make for retirement. Now, there are lots of different brokers and lots of different investment funds out there that you could look to invest into for your retirement. But one of the ones that I've stumbled across from using the platform is over on Vanguard UK, and that's their target retirement funds. Now, these target retirement funds are great because they're ready-made investment portfolios that you can pick based on your forecasted or predicted target retirement date, whether that's 2025, 2035, 2045, 2055, or even 2065. And what you'll specifically notice about these funds is that the asset allocation within them actually differs the closer that you get to retirement. And the reason why they differ is because the fund itself automatically lowers your risk over time. And they do this by investing into lower risk assets like bonds. So this means the value of your money should fluctuate far less the closer that you get to retirement, because you might need to withdraw it. But what returns can you expect to receive from investing into this type of fund? Well, just in the past 5 years alone, a £10,000 lump sum investment today would be worth £17,818. That's the equivalent to a compounded annual growth rate of 12.25%, which just for the record is a phenomenal rate of return. Now, naturally speaking, this fund will become lower risk over time, and therefore the returns will be lower too. But even let's say if this fund is able to average out about an 8% return on investment over a 30-year time period, the future value of your money would actually be 109,357 quid. That's nearly a 1,000% return on investment, which certainly isn't anything to turn your nose up at. Third up, let's say you're the type of individual that wants to make a small fortune on their money and you're not too interested in investing into lower risk assets like bonds, and instead you want to go all out in equities instead. Well, that's certainly an option because you can invest into something called an exchange-traded fund. Now, without complicating things too much, an exchange-traded fund, or an ETF for short, is a fund that tracks the overall performance of a broader stock market index like the S&P 500 or the FTSE 100. And basically what this fund allows you to do is to own a small amount of everything for a pretty small cost. Now, just to elaborate on that point very briefly, the way that ETFs work, because you're investing into essentially a whole stock market, you're actually investing into lots of different individual companies just made up as one bigger fund. And because of that, those companies are obviously across many different industries. And as such, you get a huge amount of diversification within your investment portfolio. So admittedly, whilst you do have a slightly higher risk investment portfolio, you've largely mitigated a lot of your risk by investing across the whole market. But what returns can you expect to receive from something like a Vanguard VUSA S&P 500 ETF? Which, on a side note, you can find directly on the Vanguard UK website, or you can use other popular investment apps like Trading 212 as an example, and I'll leave some links down in the description below. But from a return on investment standpoint, it can be broken down into two elements. Firstly, you have the capital return, which essentially comes from an increase in value of the fund itself, which is directly linked to the increase in value of the broader stock market too. So as companies make more profits and the circulation of money continues to increase over time with inflation, then naturally speaking, the stock market on a long-term average should certainly go up. Then secondly, you have the income return, which is another word for a dividend. Now, a dividend is typically paid on a quarterly basis, and the dividend payment will show up as cash in your stocks and shares ISA account, which you can either look to withdraw and spend, or you can look to reinvest that money instead. Now, based on the real rates of return that this fund has been able to achieve, if you actually reinvest your dividends over time, a £10,000 lump sum investment over the past decade has actually turned into £36,814, which is the equivalent to a compounded annual growth rate of 13.91%, which over a 30-year period, if you're able to consistently achieve these types of returns, then that £10,000 would actually be worth a staggering 633,705 quid. And as a bonus tip, if you adopt the strategy of just cost averaging into the market, an additional £200 per month every single month for 30 years, then that £10,000 would actually be worth £1.7 million. So retire a millionaire, you're done and dusted, you won't need to ever look at another investment strategy. But if that strategy is a little bit too boring for you, and if you are looking to get into the nitty gritty of being a stock market investor, perhaps you might even see yourself as the next Warren Buffett, in which case the stock picking strategy may be the best one for you. Most of us know the Warren Buffett story. He started investing all the way back in the 1940s into a handful of his favorite companies. He increased his holdings over time, and as of today, he's actually worth over $110 billion, which for context could buy him 167 million Big Macs, 2 million Tesla Model 3s, or 344,827 average price households over here in the UK. Now, for the likes of Warren Buffett, he's generated most of his wealth from investing into blue chip stocks like Apple, Bank of America, Chevron, and Coca-Cola, with Apple being his most successful investment up until this point, with a forecasted price per share paid of just $37.17, compared to Apple's current market price today of $146 per share. That's a potential upside of $100 billion with a B that Buffett's made just on this investment alone. So if you fancy your hand at trying this investment strategy, you may actually go on to achieve similar rates of return that Warren Buffett's been able to achieve of about 20% per year. Now, as a caveat, I think it's probably fair for me to say that these returns are very, very uncommon, especially on a long-term average. So because of that, I'd certainly just still have in the back of your mind, what's actually realistic when investing into the stock market, specifically when you're investing into individual stocks. But if in the event that you were able to achieve a 20% rate of return per year for 30 years, your £10,000 investment would actually be worth £3.8 million, which is absolutely insane. Then finally, let's throw a wild card into the mix, which is investing into real estate. Now you might be thinking, Mitch, this isn't 1985, how on earth can I afford to invest £10,000 into the property market with today's current property prices? And to be fair, you'd probably be right, because if all you had to your name was £10,000, the chances are you probably wouldn't be looking at real estate investing as a mechanism to grow your wealth within the short term. Because the truth of the matter is, you're probably going to need a little bit more than £10,000 to invest. But let's say you're the type of individual that's got a little bit more than £10,000 just sitting around doing nothing, or perhaps even if you've got access to some investor funds that could actually look to help you build out your property investment portfolio. If in that case, then it could literally just open up some more doors for new investment opportunities. And especially if you're considering properties a little further up north, which are certainly a little bit cheaper to get your hands on. For example, in Liverpool, you can pick up a 2 or 3 bed terrace property for about £80,000. Now with a 25% down payment, that's just a 20 grand deposit. The benefits of this strategy are as follows. For the £20,000 which you've invested, you've actually now gained control over an asset that's worth £100,000. And basic math tells us that a 10% return on a £100,000 asset is far greater than a 10% return on a £10,000 asset. Plus, if you rent the property out and get it to cash flow, you get to keep all of the profits that that property has made you throughout the duration that you keep it. And let's say in 30 years from now, the property has gone up in value to the tune of about 4% per year. That actually leaves you with a future investment value of £331,000. And that's just on the value of the asset alone, and discounts any kind of profits that you've made from renting out the property too. And of course, there are multiple different property strategies that you can look to leverage in order to increase the value of your £10,000 or £20,000 initial investment to far greater amounts than £331,000. So there you have it, my top 5 ways to turn your £10,000 into a sizable amount of money. Now, if you want to know a little bit more specifically what I'm personally investing into right now, then be sure to click on this video here, which is my latest Trading 212 investment portfolio update next.